with Life 180, and I got Matt and Jeff here with me today. I'm sure some of our other friends will join us soon enough. But as we like to be prompt, we are getting started. We'll have other agents on the panel join in as we go. But today we're going to be talking about whole life insurance. I was screwing around on ChatGPT the other day, and it's just kind of fun. I always like to see like what ChatGPT thinks about different topics, and being that we're in like this space, and like I feel like I know more about life insurance than ChatGPT, right? And so it's like it's just one of those things. Like it's a really fun exercise to utilize ChatGPT in like kind of interesting ways, to ask it its opinion about different things, and I love getting it to like make lists and see, like I just asked it, and I was just like, hey, what are 10 facts about whole life insurance, ChatGPT, that you think would that people need to know? And I saw the list, and I'm like, that list sucks. Like that's just not a good list at all, and so then I was like, well, let's do our own thing. Let's talk about it. And so we'll see how this all goes. But like I thought, to get started, what would be fun is to start by talking about our favorite facts or our favorite attributes of whole life insurance, like things that are just factual, regarding the policy, not our not the intangible things, so to speak, that we all love it for, like the control factor, right? Like in all the different ways that we can use it, and all the ways it makes other money better and stuff like that, because that obviously plays into it. But like the actual facts of the attributes of the product that you love it for, right? And so I just thought it'd be fun to kind of get into this. So let's start. Who wants to go first? There's only a couple of us right now, so let's start. Matt, I'm putting you on a spot, bro. I'm gonna have you go first.
So I'm gonna go deep on this one, guys. It's not so much of an attribute of whole life, but I think it's an attribute it creates within yourself by having whole life. So one of the things, that a statement that I thought to myself, and it's gonna take a minute, I'm gonna have to dive into this, but whole life makes you virtuous. And you can sit back and think, okay,
coming from the Stoic, that's pretty cool.
That's interesting. How the heck does whole life make you virtuous? So,
yeah.
I mean, if you know anything about Stoicism, the Stoics held virtue as the highest good, right? It's the only way to achieve true fulfillment and happiness. And so the four main virtues that the Stoics really focus on was wisdom, courage, justice, temperance, right? Wisdom is just accumulated through learning. Courage is not so much physical courage, but also moral courage for standing up for what's right. Justice is doing what's right. And temperance is just, having discipline, moderation, and stuff like that. And when you look at whole life, it requires you to build character. And to me, I think it's excellence in character. So if we look at, well, what kind of character does whole life really get you to build? And I just created a list here. One, it really falls under the realm of justice and courage, doing what's right, standing up for what's right. One of the characteristics is your focus on putting people first, right? Life insurance and what it's going to do for your family. I think that requires courage to think about others before yourself, right? It's the right thing to do. Another characteristics, it makes you goal oriented, which is attained by wisdom. We all know that setting goals achieves higher levels of success. It forces you to be a good steward of money, which falls under temperance, moderation, discipline of not going out and spending money, and actually being thoughtful of what you're doing with your money. Another characteristics that it builds is intentionality, which is achieved through wisdom, right? Commitment, which I think is key to success. Discipline, which falls under temperance, and living with purpose and meaning. So when I thought about whole life, it's like, yeah, there's a lot of things we always talk about and people kind of know, but I think there's undertones like people don't realize how it actually builds you up, builds your character. And of course, I tied it to Stoicism.
That's like amazing. We're doing a video on that tomorrow. Like we're going to focus on that. Like our live tomorrow, if you're watching this right now and you want to dive deeper in this is what Matt and I are going to like really dive deep into tomorrow. Like that's fantastic. That there needs to be a video about money for Stoics. So like that, I think it's amazing. Thank you for that. That's a great way to start. Mr. Kamke, how about you?
Gosh, I hate to have to follow that up. That was awesome.
Yeah, good luck, bro.
Right. I'm going to let y'all down from here on out, but no, that was awesome. I think, and I can't remember if I've shared this before on the live here, but my mind, when you first put this out this morning, Chris, it went to my grandpa was a third generation farmer. And for me, it's the lineage aspect, the generational aspect, and what this means for what we do in our lifetime, what this does for future generations. I feel like that is probably the biggest piece that hones in on me, that hits me the deepest, is knowing that my kids and grandkids, I'm changing the trajectory in their life by the decisions I'm making right now with Whole Life. Yeah, it could be about buying cars with IBC. Yeah, it could be about death benefit. Yeah, all that other stuff. But really, to me, the deepest point that it hits home on is, what is the life that my kids are going to live and their kids going to live because of the Whole Life, setting it up in the way that we do, to where they're going to, provided they follow through on everything. But if they do as we teach, they can live a better life. And I look back at the generations before me without that information, and how they were 3 generations of farmers. They stayed relatively the same class. Yeah, my grandpa had a boat. Whoop-de-doo, it was a 21-foot rinker. It wasn't like a luxury, super yacht. So, I looked down through the time, and, when my grandpa got to where it was the end of his life, and it was just as we were coming into learning all these principles around Whole Life. And I'm like, gosh, what a missed opportunity for, my mom, my aunt, which were the kids, me, the grandson, my kids. There could have been such a different outlook on all of our lives. Hence, if my grandpa and before had any type of financial literacy around how to use Whole Life, it could have meant a totally different, life for all of us, in a way that we could just up level ourselves financially, where we're not working to get out of the same struggles and ruts financially that the few previous generations did before us. I've always looked at this like there's got to be a better way to go about this than the traditional stuff. And that's always what stood out to me with Whole Life, is being able to make that change. And I'm brought back to a Facebook meme, probably a year or two ago, that I saw, that I kind of tweaked my own, but the gist of it was basically that my kids are going to grow up not knowing what it was like to deal with the struggle and the poverty and the paycheck to paycheck living. Like, the decisions that I'm making right now are going to change their framework of how they view life and the decisions that they're going to have to make. And I feel like, to kind of go along with what Matt's saying here, kind of the deeper spiritual level stuff, is I want my kids to have to deal with things that are at a higher level than just trying to live paycheck to paycheck. I want them to be able to build themselves and dig deeper into who they are, and work on aspects of them that are beyond just, how do I make enough money to put food on the table? How do I just make enough money to get by? Like, let's go deeper than that. Let's get into the deeper aspects of spiritual maturity and doing those things. So for me, that's what really rings true when I think about the parts of Whole Life that I love the most.
It's really fascinating when you break that down and you say it like that. It's really I think there's such a validity to that thought, the importance of being able to have your finances set up in a way, or maybe be set up for success in such a way where you don't have to be worried about, how am I going to pay the bills, and how am I just going to survive, and you can focus on developing yourself and growing into who you're supposed to become. And like, money is able to be leveraged as a tool that way. And what's interesting is, for me, being down here in the Dominican Republic right now, that's something that like just keeps coming to mind. And you guys, when you get down here, you'll see it. It's like amazing, beautiful people, the culture, the people, they're like all like look out for their neighbors. They cook meals for each other. Like, it's like super cool. And every single one of them is only worried about how are they going to get through this week or tomorrow or, whatever. And so it's really hard to like evolve and like improve and think about, you know, things like having a tidy area, or, you know, having, you know, thinking about how do I want to set my kids up for success when I can barely, you know, think about figure out how I'm going to survive through the next, you know, week or two or year or whatever it is. And so, and I think it just goes to show generationally how that trickles down, you know, like it's a hard cycle to break, and it takes somebody that's courageous enough, that's bold enough, that's disciplined enough, that's you know, willing to carry the load, you know, and take the stress, take the anxiety, take the responsibility that goes with trying to create that. It doesn't happen by accident. You know what I mean? Like us in the United States, you know, it's easy to forget, right? Like how hard it was for people in the 1800s, right? Like as they were building and forging the nation, and like everything from roads and infrastructure and technology and just like farming and like all this stuff that's just so easy to just be like, yeah, look at how good we have it. It's like all on the backs of our ancestors, you know what I mean? And it's so easy to like just take it all for granted. But for me, like just being in this environment down here, it's really made it like come to life about like, cause I constantly like, whoa, this is what it would have been like in 1860, you know, like for real. Like it's that bad. I mean, people, there's still where I live here on the island, you guys will see it. It's mind numbing. There's still people using horses as main transportation, you know, going 8, 10, 20 kilometers sometimes, you know, like it's crazy, you know? So, but everything's a little different. But yeah, it's, I love that. And I think it's just a great perspective. So Charles, how about you?
So tying back into what you're saying, Chris, is it takes that one person to really change the trajectory of the family name. I think Ed Milet, he's got a keynote presentation and he says it best. He's such an awesome communicator. But he goes, are you that one guy? Are you the one guy that's going to change the trajectory of your entire lineage? Right?
Yeah. Yep.
With Whole Life, we have the power to do that. Right? Whether we build the wealth ourselves or whether the Whole Life policy gives that runway to the family to build off of, we have that ability. But we got really philosophical with everything that we were saying. I want to bring it back to some of the numbers.
Oh yeah, I said let's not get philosophical. Way to go, guys.
Which, you know, it goes hand in hand. But anyways, one of the things that I'm really excited about with Whole Life, and I nerd out on it a lot, is that by having a Whole Life policy, if you have a standard rating and you give it a 10-year funding period, you will have a better risk-adjusted return than your standard bond portfolio. That is huge in retirement. That is 100% huge in retirement. In a rising interest rate environment, the 60-40 bond portfolio split is broken. It does not work because
somebody's been watching Tom Wall.
Boom.
Love that
because
guy.
in a rising interest rate environment, the prices of bonds go down. Right? You can lose money with bonds, and that's most people don't even understand that, but you can lose money with bonds. If you have a Whole Life policy, it's a bond alternative with a better return when you consider the risk adjustments inside of it. So that's what I'm really excited about. So having Whole Life in your retirement, it's not a one size fits all, but it complements your retirement, especially if a lot of your income is going to come from your 401k as a volatility buffer. Yep. So that's one fact that really fires me up, and it's so powerful to have a portion of your finances in Whole Life, especially in your retirement.
That's amazing. I love it. So I guess it's my turn. And this is really hard because I don't I don't know. It's hard for me to just break it down to one. But I would say for me, it's the flexibility. Whole life the fact is it's more flexible than most people realize, most people think about. And what I mean by that is, as we go through life, our needs are going to change, our philosophies are going to change, our desires are going to change. And there's no other asset in the world that is flexible in the way that whole life insurance is, in the sense that it will grow with you and evolve with you and meet those different needs and provide different flexibilities and open up opportunities as you see them. When we're 20, I say this all the time, I've done videos on this, but it's like, when we're in our 20s, let's face it, when I was in my 20s, I'll tell you what, I didn't give two craps about having life insurance, right? I didn't need it. I didn't know what I didn't know. You know what I mean? And I just wish I could hop in like a DeLorean and just go back to like 2001 and talk to myself, and be like, hey, dude, you got to do this, and if you do, I swear the rest of your life will never be the same. Just be disciplined. You're going to make a lot of money in your 20s. Be disciplined with it, do this, and you're going to be set up. It would have saved me a lot of heartache, and a lot of the roller coaster ride, which I guess I should be grateful for the roller coaster ride, because it kind of forged who I am as well. But, there's something to be said for that. When we're in our 20s, we don't really care about, the insurance, but what we do care about, what we should care about, is starting to save money and starting to grow, starting to build an opportunity fund if we want to start investing in real estate or anything of that nature. Okay, that's our 20s. As we get into our 30s and, we kind of smarten up a little bit and maybe find a spouse and, start having kids and these kinds of things, that's where we start caring about insurance, right? And, as we then get older and we have different needs for our money, and, we obviously, maybe we want to keep investing in real estate or investing in other business or whatever, the cash value is going to keep growing, keep getting enhanced, keep evolving with us, and the more we do it, the more consistent we are, the more dedicated we are, the longer we're committed to the process, the more it's going to naturally create more and more opportunities. So Matt said it before, is I say this all the time. I think you said it in a little different way, Matt, but it's the reason I love this, I'm going to go philosophical for a second, is that it forces you to become who you need to be to live the life you want to live, right? And the cool part about it is you can start with the end in mind, like Stephen Covey always says you should do, and think about what is the desired result that I'm after in this life, right? Because if we're not doing that, what the hell are you doing, right? You're missing the boat, you're missing the ball. And so, you start with the end in mind, and then you can reverse engineer that process. But the cool part is, by doing this, you just know that no matter what, you're able to actualize a result. You can, that you've basically purchased that result by having this product, right? And I could go save my money in a bank, or I could save my money in a whole life policy. And if I have my money in a bank and I die, well, then whatever happens, my hard work to that point in time, somebody's going to benefit from it. Don't get me wrong. But it's not going to be if I died right now with no life insurance, my family will benefit. It's not that it will be for nothing, right? I have more assets than debt. I have all the, so it's people will be better off based on the fruits of my labor in this lifetime if I were to die right now with no life insurance. But because I have life insurance, if I die right now, everything that I'm working towards, at least at my current state of ability and network and everything gets completed in a flash, And the fact is, there's not another asset in the world that's going to provide you the growth and the ability to just gamify your life and have fun with it. How cool is it? There's the old statement, that people go, hey, Charles, if you knew you couldn't fail, what would you do? Yeah. Right? People ask that all the time. That's a very Tony Robbins-y kind of way to go, right? Oprah Winfrey would ask that a lot, right? That kind of deal. If you knew you couldn't fail, what would you do? Guess what? If you implement whole life insurance as a foundational asset in your life and you let it grow with you, you're guaranteeing the result that you're after.
Yeah.
Think about that. So now for me, like, listen, I'm a little bit weird, right? Like, I take a lot of risk in a lot of ways that most people would not be comfortable with. And I don't suggest anybody do what I do, but I guarantee you Matt's going to do things that I probably wouldn't be comfortable with, and Charles is going to do other things, maybe, like, and it's okay, because, you know, you do things in your own unique abilities, right? Like, and that's, I think, part of the journey. And for me, what I just absolutely love about this stuff is that the gamification of knowing that I've literally already won. It gets kind of biblical in a way, you know, where it's just like the game is already won. You know what I mean? We know that we've got this result and it's guaranteed. If we just keep working at it, I can't control whether Life 180 becomes what I want it to be as an agency. I can't control, I mean, I can work towards it, right? But at the end of the day, there are variables that may come into play, you know, whatever, that may be a little bit out of my circumstance or hands or, you know, control or whatever. And so, like, if I didn't have this whole life policy and life insurance and a whole financial strategy involving life insurance on the back end of everything to guarantee that it will happen, well, then now I'm stressing out because all that pressure is on me, right? Because if I don't succeed, I have a family that suffers. But by having this, even if I, like, go through, and how many people have had success for 20, 30 years and then bang, they get sick, or they, you know, their business fails because the market changes. Like, my wife, Hannah, has a family member that used to make just bank in the 40s and 50s and 60s. They were like one of the wealthiest families in like the Saratoga, New York area, because they made these things like these leather hopples, and they're like for horse racing, you know what I mean? And like they did these things, and they were like the premium, like you know, just hop, whatever. I think it's a hopple, is like, I don't even know what it is, but it was it's this contraption that horses would use. And guess what? They came out with a new technology that made their thing obsolete, and it was and this company that was one of the most successful companies in the area became completely worthless. And in a generation, because they didn't have it, the family had to start completely over from a wealth creation perspective. Like, and so that family, imagine if they had whole life insurance in place, even if the company failed, the whole life insurance would have been there to just make sure that result, and the financial result of it all, at least, would have been actualized, and that would have made it way easier for the next generation to recover. I don't know. What do you guys? So,
well, I think when you said the game's already won, that made me think. I'm like, wow, that's a really good way to look at it. Who wouldn't want to play a game that you can already win? You already know the outcome. For sure, your family's taken care of, or you already have a certain amount of money. If that's the amount of money that you need to live off of, you already won the game. And if you created a policy where you know the outcome is something that you feel like, okay, I'm winning with this outcome, then it becomes a cool little game that almost also creates accountability. Now I got to do what I need to do to make sure that amount of premium going in every month or annually or whatever, right? So it is kind of like a fun game when you think about it like that. It's like, totally. You know, you're going to win. You just gotta be able to pay the premium. So now it's like, okay, what do I need to do to pay the premium? What value can I add? Or maybe work multiple jobs or get a job that pays well. But now it becomes actually fun. Like there's purpose behind what you're doing. And you know, I think there's a lot of people that don't like their jobs. They don't find purpose in it. Well, now you just create a purpose. The job's not the purpose of the job is not the purpose of you liking it. It's to, you know, win this game that you already know you won, which it's a pretty cool way to look at it.
That is awesome. Charles, you made a comment about risk-adjusted returns, and since you've been dealing that, I'm going to put the comment up here, and I want to have you give kind of a response to that.
Yeah, definitely. So Pistol Pete, there is not a mathematical expression that I know of within an illustration at a whole life company. But what I would encourage you to do is research the findings of PhD Tom Wall and Dr. Wade Pfau, who are basically the pioneers behind why whole life makes sense in retirement. And just from a perspective with wait, Fao, he didn't come from the insurance side. He came from the equity side. And through his findings and through his research, he found that utilizing a whole life policy and your 401k and something backed by equities in combination will give you a more efficient retirement, the most efficient retirement. So definitely look into those two guys, because they'll give you, like, you can dive really deep into this stuff and actually see the math and the science behind why whole life is so effective in retirement.
Yeah, for sure. And I'll add to that just by saying, whole life insurance, and Charles, you kind of touched on it a little bit, but whole life insurance is, in my opinion, over a long period of time, is an enhanced bond portfolio, right? Because it's got a lower standard deviation, right? Like, so like when you're in retirement, that's super important, because you don't know what the market is going to be. I think bonds have had such a run from the early 80s through, a couple of years ago, that we were in this low and, declining interest rate environment. And when you're in a declining interest rate environment, bonds are king. Like, I mean, people crushed it in the 80s and 90s with bonds, and to that accord, so did life insurance companies, right? Like, I mean, like, it is what it is. Life insurance companies, I was talking to people running the general fund at the company I was working with back in the day, and they were saying they were having bonds, that 30-year bonds, that they bought in 1981, that were maturing in 2011, but it was literally they had these 19% bonds coming off the books, right? 30 years later. And if you go back to 2011, you look at the interest rate environment, and to realize that, like, that's what these life insurance companies do. You know what I mean? They find these environments, and when they have the opportunity, they, from a risk-adjusted perspective, they go, okay, when's the next time we're going to be able to have 30-year bonds pay 20%? Probably never, right? And so what we're going to do is we're going to go all in, and we're going to lock in this result for 30 years. You know what I mean? And because they're dealing with such massive portfolios, they can do so. You know what I mean? And they're not buying bond funds. They're buying bonds, treasuries, stuff of that nature. Now, they'll do corporate bonds. They'll do, mortgage-backed securities. They'll do other things of that nature as well. But it's all AAA rated stuff. And so what happens is, in those times, the insurance company is going to, like, go super long on the high interest rate environment. And then in the 20 teens, right, when interest rates and bond rates were in the twos, they were doing 3-year bonds, 2-year bonds, 18-month bonds, right? Like, and they're rolling them over as quickly as possible, because they're not going to commit to low, returns for long periods of time when they don't need to. And so that's where they're literally managing that risk from a long-term perspective in a way that, quite frankly, the average individual doesn't even have the ability to do, right? Unless you're super wealthy already and, like, whatever. It really gets you access to, when you put your money into the general fund of a whole life insurance company, which is what you're doing effectively when you put the money into cash value of your policy, is your money goes into the general fund, and they're managing the money, and you get paid a dividend, through the policy, right? Through your participation with the company. And, with that, the crazy and to me, the cool part is, like, you're benefiting from that, but, like, you're getting that money management that you can't get outside of a life insurance company unless you're worth millions of dollars. Like, like, that's awesome, And most people don't realize how important it is to have that safe money management. Most people think about money management being like, I'm trying to get this big risk of, big return and all this stuff. Is like, no, having the management of safe capital and getting the highest return possible with the lowest risk possible at the foundation of your financial life should be the focus, because that's what wealthy people do. Wealthy people don't go to just try to hit mindless home runs, and just take big swings without understanding the downside risk to it all. And they have it all balanced, right? But somehow, because of social media and lack of education and marketing and, all these things by the financial institutions, they kind of position it as like, no, the younger you are, the more risk you should take. And you know, people go out there and they have no savings and they go put all their money into crypto and altcoins and all these things that they don't understand. Not that I even have a problem with altcoins and crypto and all that stuff, because I'm totally cool with it. I own some, I love it, like whatever, but it should not be a high percentage of your portfolio unless you are consciously saying, I really don't care if I'm successful long-term. Like, you know, and unless you're willing to just be like, I am taking a total flyer and I'm basically buying a lottery ticket to see if my life succeeds. In which case I would argue that's probably not the best choice. You know, I don't know. That's just me. But, you know, so like, I don't know that there's an actual mathematical expression. I think you'd have to look at the risk adjusted returns of a bond. You'd have to look at the fact that whole life insurance, the nature of whole life insurance, there's not another asset in the world that's paid a dividend and given a positive return to its shareholders effectively, right? To its policyholders every year for 160 years, 180 years. There's not another asset. There, even bonds, you're not going to have positive returns every year. Just look at the last couple of years. And the bond portfolio, you know, the 60-40 portfolio is dead. The fact that, you know, we have, what is it, 2 years in a row, the market went down and bonds went down. Like we had a loss in both bonds and stocks. Like that was pretty gnarly. You know, people weren't expecting that. What do you do if you're banking on, like, when stocks go down, my bond portfolio is going to bail me out, and that's where I'm going to pull my income from. Guess what? If you were relying on your bond portfolio in retirement, part of the 60-40 portfolio, and not utilizing whole life insurance as a volatility buffer, you were in trouble potentially, right? Unless you had a big buffer, right? But if you had whole life insurance, guess what? You could still, like, you didn't lose money. You still got paid your dividend, and you probably earned 4.5% in your policy, and you could take that out and you were good to go. Whether you do it through a policy loan or a partial surrender of the policy, or you just use the dividend if you had a big enough policy to pull income, you know, use the dividend as income for that year. There's so many different ways that you can do it that people don't realize, you know. But that just goes to the flexibility of it all. You know what I mean? And that's what I was talking about. Is like, no matter where I am in life, I need to save money. I then have a family. I have kids. I've got college payments to worry about for my kids. I want to hide money from the FAFSA when my kids go to college. I have living benefits to make sure that I have control of my medical directive when I hit retirement. I've got a volatility buffer as a bond alternative in my portfolio that we're talking about. I'm going to be able to pass it on a guaranteed. It's going to be the stop, you know, the backstop to my financial success, and make sure that even if I wind up in a situation that my wife's family did with the Hopple, you know, and their business is successful for 30, 40 years and then it crashes, you know, this is the backstop to my success. This is going to make sure that what I work so hard for, nothing's going to take it away, you know? And so, like, these are the things that people don't look at when they are just looking at the illustration, and they're looking at the returns in the illustration and being like, oh, why would I put my money in a whole life policy earning 4.5% when I can put it in a mutual fund and earn 8%, you know, like
12% every year.
Yeah. I mean, I'm not even going there, you know, like, it just, these are the intangibles. Right. And so, yeah. So you guys got anything else on that?
I think a lot of the intangibles, people, like, even if you didn't even disclose you're talking about whole life, you'll find that a lot of people believe and they value every characteristics and attribute of whole life. So it's just really fun. Like, to me, like, appointments and meeting with clients are so fun because I already know you already believe in all the attributes. I just got to get you to see it. That's really the game.
Yeah. You just don't know what you don't know.
Yeah.
Right. Go ahead, Charles. You were going to say something?
Yeah. You were saying how the wealthy people have a whole team of people to manage their money, right? When you're super wealthy, you'll typically have what's called a home office. And basically you have lawyers on retainers. You have
a family office.
Yeah, family office. That's what I meant. Family office on retainer. You have all these people. It's very smart money. It's very calculated. As the average person, we may not ever get to that point where we can afford to have those kind of people on retainer. But having a whole life policy is kind of like having an extension of a family office. So the money is super smart. You have general fund managers within the whole life companies just really managing that money extremely responsible and getting you those decent returns. You know, they're not amazing, but at least they're consistent and they're reliable. So another thing you mentioned, Chris, was the sequence of returns risk. When the market goes down and the bond market goes down at the same time, that takes a huge hit to your sequence of returns risk. And that's a theory of how you would withdraw money in certain market environments. And in that market environment, it's a super detrimental period in time that can really hurt the overall outcome of your retirement. And so by having that whole life policy in place, utilizing it as a volatility buffer, if those things go down, instead of pulling money out of your 401k or the bond portfolio, you just pull out of your whole life policy for the time being, allow those equity funds to recover, and then start pulling out of those funds in the future. And it makes it that much more viable, and you'll have a better return with your retirement by utilizing those strategies.
I love it. I love it. Matt, did you have something else you wanted to say, or was I just not picking up your body language right?
No.
You're good?
That's
You're good?
Spot on.
All right. So let's do this. You guys want to see what ChatGPT said for the top 10 things people need to know? All right. I'm just gonna read them. Okay. Let me see. I gotta find my tab with it. All right. So when I asked it, this is kind of fun. So I'm gonna go through it really quickly because like I didn't use this, but I just, you know, and I dove deeper and asked different questions, whatever. But just from a basic level, when I asked it, I said, here's my query. I said, I want to do a YouTube video about whole life insurance titled The Facts of Whole Life Insurance You Need to Know. Can you list some facts that you think people should know? And then I said, then I'll coach you to improve them, right? Just kind of letting it know I didn't want to just ask one question. But the first thing it gave me was, number one, give a definition and the basic features. And it said, fact, whole life insurance is a type of permanent life insurance that covers the insured for their entire lifetime, as long as premiums are paid. If it not only provides a death benefit, but it also includes a cash value component that grows over time. All right, that's fair, right? Number two, the fact is the cash value component. The cash value in a whole life insurance policy grows at a guaranteed rate of return. Policyholders can borrow against that cash value or even withdraw from it under certain conditions, but this can reduce the death benefit, okay? And if you guys have anything you want to say to these as I'm going, but you know, I'm just going to rip through the 10. Fact number three, you have fixed premiums. The fact is whole life insurance policies typically have fixed premiums, meaning the amount you pay in premiums remains the same figure throughout the life of the policy. This can make budgeting easier for policyholders. I would argue that that's actually not a fact. There are elements of the policy that are fixed, but if you are designing your policy where it's fixed premiums the same way the whole policy, you're probably doing it wrong, or at least not efficiently, unless your only goal is estate planning, right?
Yeah.
Dividends. Fact four, dividends. Some whole life insurance policies, you notice it's this. So this is actually kind of good if you look at the nuances of it. Like some whole life insurance policies are participating policies, which means they may earn dividends. These dividends can be taken in cash, left to accumulate interest, used to decrease premium payments, or used to buy additional insurance. So that's kind of, I mean, that was, you know, really clean, really good. It didn't talk about how the dividends were paid, you know, and all that stuff, but that's cool. Five, guaranteed death benefit. Whole life insurance guarantees a death benefit to the beneficiaries as long as the policy is active and premiums are paid. This benefit is not subject to market fluctuations. It's cool. Number six, cost comparison. Whole life insurance is generally more expensive than term life insurance because it covers the insured for their entire life and includes the cash value component. So what I find funny about that one is like expensive compared to what, right? Like I could have a term policy and pay $1,000 a month, or I could have a whole life policy and pay $10,000 or $1,000 a year for a term policy, or $10,000 a year, or let's call it $12,000 a year for a whole life policy. And people would be like, why would I pay for $12,000 when I could pay $1,000 and have the same thing? But if I showed you 10 years out that the 10-year term ends, that $1,000, and if I've lived, I've now just wasted that money. But if I also show the whole life policy and I've got more cash value than I've actually paid in premium, and I have the death benefit still from that point moving forward, you tell me which is more expensive.
Yeah.
You know what I'm saying? Like,
Chris,
when I have the liquidity of that money, it's just mind-numbing how people, it's not more expensive. It's going to require more cash flow. It's going to require more vision, more commitment, more dedication, more, more execution from you in different areas, But to say that the insurance is more expensive is just not even accurate compared to what, Like, it is what it is.
Chris.
On a gross basis, it's more expensive, but on a net basis, over a period of time, it's cheaper. Go ahead, Jeff.
Yeah, I get so many Dave Ramsey things in my Facebook queue, like the ads, and they are constantly harping on that point. And the more I see it, I'm starting to get just as irate towards Dave as you are towards IUL, Chris, because it's such a half truth. It's such a narrow viewpoint of only the first term. It's like, what happens if your life does not go perfect and you're able to invest the difference, and life happens, you have a medical illness, you lose your job, you have a divorce, like whatever happens, and you need that second or third term, guess what? It's no longer the cheaper alternative. That's what just drives me crazy, is they don't give you the full picture and they just want to talk about the first term. And it's just so I get fired up. I can't even handle it anymore.
But that's not how the world works. I mean, all of us, I'm sure everything in our lives has all gone perfectly, right? And everybody watching this, they've never had an issue. They've never had a plan that didn't go according to how they, had laid out. Everything goes perfectly for people, doesn't it? So we should just plan for the perfect scenario, and then when it, and you'll always be good. Yeah, and I think that's a good point, right? Like, and I think that's the philosophy, is if you're planning for for that scenario, you're basically putting yourself in a position where maybe on paper it looks better, but life doesn't exist. This is why I always say life doesn't exist on a spreadsheet. Life happens. And I love Mike Tyson's statement, everybody's got a plan until I punch them in the face, and I promise you life is going to punch you in the face, right? And if you go in and you buy term insurance, it's basically, what was the boxer? Like, I remember watching Mike Tyson go against this guy, and he hit him one time and he just crumbled like a sack of potatoes, that's basically like your term insurance plan. That's going to be an awesome meme. We should find those videos and make a cool
term insurance
video about that. Yeah. That'll be fun. But that's, I'm joking, but I'm also being serious, it's just one of those things where life is going to happen. You're going to have struggles. And I promise you, it is impossible for you to visualize where you're going to be in 10 years and to know where you're going to be in 10 years and what life is going to be like and what challenges you're going to have and what anxieties you're going to have and what stresses you're going to have and what's going to fulfill you in 10 years, it's going to change. Right. And so why follow a strategy that basically only works if everything goes exactly perfectly the way you think, the way you feel and operate right now in this moment in time, when pretty much every variable that goes into the outcome that you're planning for, is going to change, yet somehow people buy into that. And
how you will.
Yeah, I will. Exactly. So that's that. All right. So let me keep going here. Let me get back to this. And what was the last one? Cost comparison. That was the last one. Yep. 7, suitability. This is interesting. Whole life insurance may be suitable for individuals looking for lifetime coverage, estate planning, or those interested in the policy's cash value as a tax-deferred investment option. So I have a big problem with this one all the way around, because I would argue they didn't talk about anything to do with an emergency fund. we've talked a lot about emergency funds on these videos. I talk about them all the time on my videos. How if you're going to have an emergency fund, the typical person's emergency fund basically is planning on losing your job. Whereas to me, a real emergency is like, getting cancer. And what's your emergency fund going to do for you in that environment? Whereas a life insurance emergency fund is going to give you the cash value and the same benefits of your bank and the benefits to help you with your medical issues. And so this suitability thing, I think they missed the ball completely. Number 8 is loan against the policy. Policyholders can take loans against the cash value of their whole life insurance policy. However, if the loans plus interest is not repaid, it reduces the death benefit. All factual. Number 9, tax benefits. The death benefit is whole life insurance. The death benefit of a whole life insurance policy is generally tax-free to beneficiaries. Additionally, the cash value grows on a tax-deferred basis, and loans taken against the policy are not taxable income. Number 10, riders and add-ons. Fact, whole life insurance policies can be customized with various riders and add-ons, such as accelerated death benefit riders or child riders, providing additional coverage or benefits. I would add in waiver of premium riders and other. Yeah, there's all sorts of riders you can add on, and then you go from there, right? Like, so those are 10. So were there any facts on there that and anything I said that stuck out? Or are there any other facts that that you would say, like, man, they kind of ChatGPT missed the ball?
Definitely the flexibility, having it fixed. Although there is a fixed aspect, the way that we design our policies is to have, for the most part, maximum flexibility, right? So we put more percentage into PUAs over the base, and that gives us the flexibility. So we have a ceiling that we can fund up to, and then we have a floor that we can minimize and still keep our policy in effect. So definitely that aspect. Whole life is more flexible than it's ever been, in this current environment. So.
Yeah, for sure. And people don't realize, like, I would argue. So, all right, we're going here. So a lot of people argue that IUL, Brian, I hope you're on. A lot of people argue that IUL is more flexible than whole life. And they speak to the flexibility of IUL as like one of the main reasons that you want the flexibility. So, or why IUL is better than whole life is because of the flexibility, I should say. So here's the thing. I was raised in a way, maybe people were raised different than me. My parents didn't have a lot of money, but they're, built in some good work ethic and morality and stuff like that, I feel like. And one of the things I was taught growing up is just because you can doesn't mean you should, right? And so, like, IUL, what is touted as the number one element of it, which is the flexibility, maybe the number 2, because they say the downside protection, they may put as the number 1 thing or number 1 reason, but the flexibility is definitely up there. I'll tell you, my experience is that flexibility is one of the top reasons I see people get in trouble, right? By having that. On top of that, I'll say this: whole life insurance can be almost as flexible. Maybe not the first couple years, but I'll tell you what, if you're needing that kind of flexibility the first couple years, you probably overextended yourself with what your plan was with the IUL in the first place, or even the whole life policy if you end up needing that flexibility. But then beyond that, the flexibility of an IUL is not really that flexible, because you may be flexible in the sense that you don't have to come out of pocket for premiums, but you can never pay up the IUL policy, right? You can do, there's a difference between paid up premiums, which you can do in a whole life policy anytime after year 7, which to me is super flexible. To know that I'm in control at year 7 and beyond, and to know that anytime after year 7, I can either use a premium offset, which is the equivalent of not paying your premium with an IUL, which most IUL agents don't even know that exists. I can do a reduced paid up where I could reduce the death benefit, get rid of all insurance fees, and make sure the policy is completely paid up, no more expenses, and now it's really just a bank account on steroids. And I still get all the benefits of the dividend growth, cash accumulation, tax-free access through loans, all these things that I can use it to with paid up additions on the dividend. The death benefit will still keep growing, and it's fully paid up, right? I can do that anytime after year 7, fully paid up. In an IUL, they just have what's called vanishing premiums, right? You don't see them, but they're still there, you know? And it's like, and they want to tout that as flexible. That's not flexible. That's setting yourself up for failure. You know what I mean? And yeah, you have the flexibility to screw yourself over. Congrats. Good for you. Right? Like, somebody talk to me.
No, I think I would argue to the grave that whole life has way more flexibility than IUL in so many different ways. And we should come up with a T-chart and just really, objectively break it down. Whole life has so much more. And I think IUL agents, because they only are trained to understand IUL at a surface level, they're not really trained to actually know the ins and outs. So they'll just say, oh yeah, they'll just tout that. But if you ask them, in what ways is IUL really flexible? Most IUL agents couldn't even actually go through a whole list. They would say, well, you can increase and decrease the premium and not have to pay. That's about as deep as they go. And that's the sad part.
Yeah, it's tough. That's tough. I mean, at the end of the day, the way I look at it is this is why I'm so passionate about doing the content that I do, and I know you guys are too. And it's like, I get so much. It's funny to me. It's actually gotten comical how many people. I'll say it this way. I literally get 5 comments a day that are like, why don't you just shut up about IUL and talk about your own product? Like, if and it's like, first of all, that's like telling like an NFL coach who's preparing for the Super Bowl is like, why don't you just worry about what you're going to do, and don't worry about how the other team is going to respond to you or defend you, or like, don't worry about what they're going to run for a defense or offense. Just focus on running your own plays. Don't worry about how the other team's going to respond to it. Like, that's just stupid. I wouldn't do that in any business that I do, and I feel like nobody should ever put money into anything that they don't understand, and so like this process, this journey, and I'm sure all of you have your own process, right? Like, Charles, I know you went through your own growth process of diving in and learning and testing and stress testing and like trying to prove it wrong, right? Like, I think that's the thing, is you got to go down the path of like really understanding this, because it's not super complicated, right? Like, I mean, I think that's one of the things I love this. Like, whole life insurance can be as simplistic or as complicated as you want it to be, right? Like, and that's a beautiful thing, right? Like, if I'm using you guys as examples just because, but like, if Jeff Kamke just said, hey, Chris, like, I have no interest in like building anything crazy and like doing real estate investing or anything of that nature, but you know what? I do care about having an emergency fund, and I got a couple kids and I want to make sure they're taken care of, and whatever, where's the best place I should save an emergency fund? And that's it. I'd be like, hey, Jeff, my personal opinion is like, well, I would be like, how much do you think you need in an emergency fund? And he would tell me a number, and he'd be like, 6 months of income, because I listen to Dave Ramsey and he's awesome. And I'd be like, all right. And maybe we'd have a little conversation about that. But honestly, to get started, I probably wouldn't fight with Jeff very much about this, right? What I would do is I would say, all right, when would you like to have that 6 months of income completed, right? And he would tell me. And he'd be like, I want to have that in the next 4 years, 5 years. I'd like to have 6 months, because I don't think I could save more than that. And then we'd come to a number and figure out, all right, what do you need to save monthly to be able to get there? And then we'd compare savings account, whole life account, and then we'd see where the cash value in each account winds up and what the ancillary benefits are in each account. And I guarantee you, Jeff is choosing whole life, like 100% of the time. if he's educated as to the good, the bad, and the ugly. Now, if we do it the right way, also, the people that would be naysayers to the whole life conversation is like, oh, well, why would you put your emergency fund, Chris, into an account where if 3 years in, you lose your cash flow and now and you can't pay your premium, because you have no job. It's like, well, the policy is flexible. And if you design it where the base, the fixed premium, as we were talking earlier, is small and the paid up additions are flexible, well, now it's super easy to have the dividend even a couple years in and use a premium offset feature or even a partial surrender of the policy to just pay for the premium for the first couple of years. You could do that super simple, if you ran into that situation. But that's the function of making sure that you pick the right company that provides the right flexibility with the paid up additions and whatnot, because a lot of companies don't. And so from that perspective, I get why people don't like it if they don't understand it and they don't understand the way all the different companies kind of work, right? And so you just gotta dive deeper and figure out what setup, what design, what blend, what company, what problems are you looking to solve, what time frame are you looking to solve them in, what's the desired result that you're after. And I think it's a shame too many people sell just whole life insurance and they're like, oh, I got you to buy your infinite banking policy. I'm such a rock star, but if you design an infinite banking policy properly, like I'll tell you this, like right now, I just got another policy for myself, right? Like, and I knew I was going to get approved for about, well, I didn't know how much. I thought it was going to be about $1.5 million because of like my human life value. And like, I know how the insurance companies kind of calculate it and whatever. I got approved for $2 million more, right? I couldn't afford, from a cash flow perspective right now with everything I have going on, I couldn't afford to put all that in whole life insurance and design the whole life insurance the way that I wanted to design the whole life insurance. So what did I do? I said, I'm going to guarantee my insurability. I'm going to buy a 10-year convertible term and I'm going to lock that in. I got $2 million and I'm 44. I'm healthy, but I got $2 million at 44 years old for $1,460 a year of $2 million of life insurance, right? Now that is guaranteed. And that's just like, kind of on top of everything else. And it's like, that's what I'm saying. I always want to maximize my human life value. Whatever the insurance company is going to insure me for, I'm going to take it, because that's them being like, hey, listen, we're doing this math and we know that based on where you are, your income, and kind of like where you are at this very moment in time, we're not going to speculate on how much money Chris is going to make in the future, right? And do it on that. But based on where you are right now, the income you're making, the debts you have, everything that you have in life, this is what you're worth in the future. Should you be a good steward of your money, this is what we think your potential future net worth is going to be, right? So when you think about it like that, why would you not want to buy that and just make sure, like, unless you're like narcissistic and it's just about you and it's not about like why you're trying to create that wealth for other people, why would you not want it? And so for me, I think the sad part is, and I'll get back to the point, is people selling infinite banking that just like, oh, the death benefit doesn't matter. Or, they sell the death benefit or they sell the infinite banking policy and people get the cash value and they focus on all the benefits and all that, which is great. I'm not like downplaying that importance. But when they step past the importance of the death benefit and not at least giving the chance to educate on maximizing your potential net worth and your human life value, like, to me, that's a problem. Like, I'll tell you, the last, a bunch of policies that I've sold, I've had two policies, a whole life and a convertible term that goes with it, because they're thinking long term, right? Now, you don't want to buy the convertible term and just let it sit there and do nothing. Your goal is to convert that over time, and maximize that. And that's having a system that's going to guarantee a result over a period of time. And that's how you gamify and make sure that whether you're wildly successful in business or not, ironically, that having the money there and having the financial foundation of liquid accessible capital is going to probably increase your chances of being successful in the short term as well. But, hey, what do I know? All right, what do you guys got? I think I'm talked out right now.
I think one of the hardest.
Charles, you go first.
I think one of the hardest things to kind of wrap your mind around with whole life is all the different problems that it solves.
Mm-hmm.
Right. So most people are very singularly minded. So they're only thinking about, oh, what's the rate of return? And that's the only metric that they're viewing their decisions from. But where whole life is really hard to grasp your mind around is all the different problems that it solves, right? So in the beginning, it's your emergency fund, it's your opportunity fund, and then as time goes on, it's the death benefit for your family, and then as time goes on, it becomes an alternative to long-term care with the chronic riders, and then as time goes on, then the estate, like the most efficient transfer of money through your estate. So it's really hard to just view the whole thing. Like whole life is like all encompassing. It's a holistic approach. So like when you break it down, it really does fit into most people's finances in some aspect or another.
At some point in time, for sure. I had Jana made a comment, Jana Perry here. She asked, do we prefer to structure the policies based upon the yearly premiums? I guess I'm not 100% sure what you mean by that question, but like what I will say is anytime I can, I want to structure the people to pay annually. If they can't and they have to pay monthly, that's okay. We can. Just know anytime that you pay monthly, there are additional administrative fees and so on and so forth, and they're going to be a little less efficient on the monthly payments. So anytime you can go to quarterly, semi-annually, annually, ideally, that would be the best way to go. But that's what we do. Now, when we also structure the policies, the structure of the policies is going to be talking about what's the base versus paid up additions. What does the front load into the policy look like? What does that blend of all that look like to create the flexibility? What with a lot of these companies, for $120, or not a lot, but a couple of them, for $120, the paid up additions rider will allow pretty good flexibility. Like you got to pay $120 a year for the rider. So now if we're talking about spending $100 a month for a whole life policy, that doesn't make much sense. You know what I mean? Because now that rider we're talking is 10% of the entire premium. If we're talking $12,000 a year, now the $120 is much smaller, right? Like, and so we can, you just got to, every situation is a little different. And so from a structure perspective, I think annual, but the structure conversation is more a matter of base versus paid up additions, including the front load. When you do the front load into the policy, that's going to also have an impact on what kind of base you need to manage the front load based on the size of the front load compared to the annual cash flow of premium that you want to do. And I think that's one of the biggest mistakes that I see is a lot of times people go, hey, Chris, I just inherited $250,000. I want to put it into a whole life policy. Help me do it. And that's the wrong way to look at it, in my opinion. It would serve me better, to just take it and go with it, right? But at the end of the day, if Charles is like, hey, Chris, I just inherited $250,000, I'm going to tell you, I don't care. Like what I want to know is, I care because it's, it matters. But as far as the structure of the policy, I do not want to start with the front load. Unless you have an unlimited supply of cash flow and you are able to be completely flexible with that and whatnot, then what I care about more is what can you comfortably afford from a cash flow perspective to manage from your premium every single month, every single year, whatever it is for you, right? Ideally annually, as we were just speaking about. So I'm going to go to Charles in that situation and be like, I want to know what you can afford from a cash flow perspective. Unless you tell me that you can, from a cash flow perspective, which by the way, not likely if he just inherited $250,000. Like his cash flow doesn't mean it doesn't. There's no guarantee his cash flow is good enough to support a big front load. He would need at least say $25,000 a year in premium. We might be able to get it down to $20,000 a year in premium. But if we go down to 20, there's not going to be a lot of flexibility with that 20 because of the front load and because of the base paid up additions blend. And so therefore he better be solid with that 20K. You know what I mean? And that's where people get in trouble, is they try to like focus on the front load and not the cash flow. I'd be like, listen, Charles, I'm stoked for you that you just got that $250,000. You know, hopefully it wasn't through like too much of a tragedy, right? Like, you know, like, because unfortunately that's how a lot of people inherit money. But what I would start from is like, okay, it's great that you got that. Let's handle this from a different direction. Let's talk about your cash flow first, and from the cash flow that you're comfortable with, because I want to make sure that this asset is always a benefit to you and is never going to put you in a situation where you're at risk, right? Where you have any kind of buyer's remorse or anything of that nature. What I'm going to do is I'm going to say, let's talk about your cash flow first. And then from there, I promise you, we'll figure out what's the most we're going to be able to front load in based on what you can actually afford from a cash flow based on your current lifestyle, assuming you had never inherited any money. You know what I mean? Or maybe we figure out also how to get that money trickled in over a little bit more of a period of time, right? And we do that. And those are also ways that you can think about it. So when I think structure, you know, I don't know, that's my long-winded answer, but like when I think structure, like those are the things that just go through my head, is like, it's always different for different people.
And to add in another layer of protection, reverse engineer what the worst case scenario looks like. Yeah. And then you can see what your minimum for that payment of that whole life policy would be. And so when you're viewing things like that, then you're ensuring that that policy is going to be with you for the rest of your life. And that's the whole point of having it in the first place. So
and that's awesome. And so think about this. When you look at a whole life policy, this is great. This is a great segue. So when you look at a whole life policy and you look at, there's a minimum premium, the way that we do it, at least there's a minimum, and then there's a scheduled premium, right? When you look at the minimum premium in a whole life policy, that's basically saying you're still guaranteed to have this policy in force, right? You may not have as much cash value, but the policy is guaranteed to be there. When you look at the minimum funding on an IUL, you're basically saying, I'm lighting my money on fire, right? And so like the comparison between the two, it is so night and day. And people talk about them like they're the same thing because the companies use the same words, you know, and they don't understand all the minutia behind the words, you know, all the nuances behind the words. So yeah, I think it's all really important stuff. So, all right. Anything else, guys? I think this was fun. Hopefully everybody else watching found it fun and got some good, you know, info out of it. Give me a comment, give me a thumbs up, give me something if you're watching this and you're liking it and it was valuable. Like it, share it, get it out there to people, all that fun stuff. Anything else from you, Matt? We're talking stoicism.
One thing, it just came back to me. It just came back to me. So what you're saying, that when people reach out to you and say, why can't you just focus on whole life? Why do you have to talk about IUL? And I mean, my response is a stoic response, is we focus on the common good for everybody in society, and knowing that other people are screwing other people.
I can't save this for tomorrow.
Okay.
Bro. Right. Stealing your own thunder tomorrow, man.
All right.
Stealing your own thunder. Guys, Matt was just about to say something super cool. So make sure you subscribe and watch our video tomorrow, because we're going live and it's going to be solid gold. It's going to be amazing. So before we go, I do want to let everybody know I got 2 spots left. If you're an agent and you're watching this and you're looking to build your business, we have 2 spots left for the Life 180 Mastermind down here in the Dominican Republic. I am here in my studio. We're right near the beach. You know, it's pretty awesome down here, and we're going to have a lot of fun. But more importantly, you're going to learn a lot, and we're going to get a lot done for you building your business. I've been talking for about 4 years now on the importance of building your authority platform. What I know is life insurance agents typically get into this business not because they want to be amazing marketers and not because they have that skill set, but because you're passionate about learning the money side of it. You're passionate about helping people with their personal finances and all that stuff. And so that said, if you really want to be able to reach people, you better be good at communicating that message. And you better have an authority platform that positions you as an authority in this space in your own way. Because I promise you, if you don't have a sales funnel, an appointment generation system, if you don't have some content on your own platform that positions you as somebody that's competent and confident, in this space, that has interviews with other people, doing things of that nature, that positions you as an expert or as somebody who's really amazing in this space, they're going to come find people like me. And, I could tell you, I get people that reach out every day being like, hey, I talked to this person in my town that works with Northwestern Mutual, and I went to college with them, and they started telling me, and then I found your page and channel, and I watch your videos, and what you're saying just makes so much more sense, and I'd rather just work with you, and whatnot. And so you gotta build your authority platform. And on top of that, I think the best way to learn is to teach. A lot of people ask me, how do I know so much about this business and all these things? It's like, if you do this and you create content, I've literally filmed over 2,000 videos now. You learn a lot just in preparation for doing this stuff, and you get to the point where it becomes like, riding a bike. But the mastermind is going to be pretty amazing. It's going to be amazing networking. But more importantly, because of the fact that, not everybody gets into this to be a marketer, and it can be overwhelming. Learning the technology could be overwhelming. We're going to have great sales concepts, what I feel are the best sales concepts that move the needle and help communicate and sell more life insurance in a value-added way. We're going to go through my top 3 concepts and go into super detail, and actually have presentations that everybody that attends is going to be able to take and customize and use for themselves, and personalize them. We're going to have, everybody's going to come out of there with an actual built funnel. I'm flying in my guy Clark from Oregon. He's going to be here, and we're literally going to be over your shoulder and have dedicated time to building out systems, whether you want to build a webinar funnel, whether you want to build a book funnel, or just your authority funnel, or anything of that nature, what's designed to put it out there. We're going to be doing everything. I mean, one of the biggest challenges people have is getting on video, doing your opt-in video, a video for your landing page, and writing the script for it, and then video, filming the video, and then editing the video, and then getting it out there. And so all that's going to be covered in this. We're gonna film it. You're gonna film it in this studio if you come. It's going to be pretty amazing. We're going to film it here. I'll help you write the scripts. My team will be here helping you write the scripts. I'll be personally involved with doing that. We'll film it. My team will edit it. We'll get everything in place, all your automations, all the technology, all that. And then on top of that, if you decide that you want to run with one of the sales concepts that we do, whether it's from a real estate perspective, whether it's from a volatility perspective, buffer perspective, whether I'm actually right now dialing in, I've been working on this. So I love this mastermind. I really work well under a deadline, because otherwise I got all these things that are going on. But I've been working on this presentation on aligning your money with your values and beliefs. And literally the thing that I've been after for a long time is creating a sales presentation that isn't like the bull crap World Financial Group sales presentation that's really just trying to sell them something, but have a sales presentation that isn't really trying to sell anything. It's just educating to get people to think differently about their own life and about their own money and about their own goals and objectives, and then position it back, not to sell them life insurance, but to get them to at least think and consider, what would it look like if I did this in my life, right? And so I've got that done. I've got it with a designer right now, and I think it's going to be cool. And so everybody that comes is going to get that. We'll be able to personalize it for you as well. We could even create like a whole webinar function around that if you wanted to. And so there's a lot to be done. The goal is to help people that come, whatever they need, because everybody's in a little bit of a different space, but there's also so many similarities, right? Like Jeff, Charles, and Matt, they're all coming, right? They all are in a little bit of a different space. They've all, especially on the marketing side, have got a little bit different stuff accomplished and are looking to do different things. But there's enough similarities between what they're trying to do that we create this custom space that by the time they all get done, they're going to have exactly what they want completed. And if you know the value of being able to just come in and hammer it out and get this stuff done in a week, like, it's the biggest no-brainer in the world. And I can't think of a more valuable thing that, you know, a life insurance agent should do with their time for a week. So made it kind of a no-brain offer. All you have to do is go to mastermind.life180.com. Hold on, I'll type it in here, mastermind.life180.com. Boom. You go there, and I only have 2 spots left, just to let you know. 2 spots left. So the next 2 people that sign up can come. After that, well, I guess technically I have like 3 spots left, depending on who's coming, but I have 1 private room left and 2 other spots left if they want. So it depends on how that goes, but depends on who signs up, I should say. And so we can go from there. But if you want to meet me in person and be there, and we'll film. Oh, and the other thing is, if you're looking to create content, I will do a podcast interview with every single person that comes. I've already allotted the time for it. We'll do it right here in the studio. My team will edit it for you. You can share it on your channel. And if you want, I'll even put it on the Life 180 channel to position you and drive traffic your way and hopefully help build your own following as well. So just going to be a fun thing, but Jeff's going to be there. Charles is going to be there. Matt's going to be there. I'm going to be there. We're going to have fun. It's going to be productive. We're going to also go have fun times. We're going to do a couple excursions that I've got planned out that I'm keeping secret because they're that cool that I'm not telling anybody about it. It's going to be a secret because I want to see everybody's face when they get here. And it's going to be fun. So hope you know, we fill those spots up. And if not, guess what? We're going to have fun without you if you don't come. So don't miss out. So that's that. Anything else, guys?
Nope. Good stuff.
That was the longest plug I've ever done on a live, I think.
That's good. Don't forget to add the link, though.
I did add it. Did it not come through?
I don't see it on my end. Oh, I did. I lied. I see it.
I did it. All right, cool. All right, guys. Well, hopefully, if anybody has any questions or needs anything, you can comment in the comment section below. You can email me, chris@life180.com. I'm happy to engage. You can also email mastermind@life180.com, and our team that's running that event will help you out. That's it for this video. Till tomorrow, where Matt and I are going to continue the stoicism and life insurance conversation, or stoicism and money conversation, and he's going to share the golden nugget he was just about to talk about. You don't want to miss it, I promise. So we'll see you tomorrow.